Okay, welcome to the August 1st edition of the Fats, Fuels, and Oils webinar. This week, we are going to talk a little bit about growing conditions in the US and the outlook for the soybean crop, and then we'll review the EIA reports that came out yesterday, feedstock usage and capacity and production, and then we'll talk a little bit about feedstock prices and our expectations for biomass-based diesel production profitability. So, all right. So over the weekend, the forecast maps initially tried to kind of go really hot and dry at the end of the forecast period. So that's like the middle of August at this point, with high temperatures like above 100 for a broad swath of the Corn Belt. And then the models sort of backed off that and now have gone basically normal temperatures and normal rainfall for the first couple of weeks of August. And that's really critical because yesterday's crop progress report showed that 50% of the US crop is currently setting pods. And so that begins the most critical phase of development in the phase when the most rain is needed. And I think one of the things that I have kind of forgotten as we've gone through the growing season so far, and it's something that's a little difficult to pay attention to, but I think the chart that Joao put together shows it really, really well. So the gray line or the gray shaded area represents kind of the average rainfall for any across, well, I guess since the middle of May. And then the purple line shows actual rainfall. And this is across a big portion of the Corn Belt, almost all of the Corn Belt. And while May was dry and the crop got in really quickly because conditions in May were really favorable for planting. However, that left soil moisture levels low and required timely rainfall to get the crop through development and essentially to where we are now, which is pod setting. And if you look at sort of the slope of the gray shaded area with the slope of the purple line, they're pretty close. I mean, they're not exactly the same. And of course, because it was dry in May, every millimeter of rainfall was needed to keep the crop going and developing, but they're relatively close. And so what that really says is that since the crop has been planted, it has essentially received normal or pretty close to normal rainfall. And I think probably a lot closer to normal rainfall than soybean futures were reflecting last week. So last week, soybean futures ran up to above $14 again. I'm not sure that they touched $14.50, but they were relatively close. And then on Thursday, the market started to sell off, and between Thursday, Friday, and yesterday, prices dropped about $1 a bushel, which is a pretty significant sell-off. Not really super uncommon given how much prices had run up in a relatively short period of time. However, the decline probably does reflect the market kind of getting its first look at what the weather is going to look like while beans are filling pods, and with relatively normal rainfall and temperatures that aren't dramatically above normal, that suggests that the crop will reach trendline yields. Now, the big question is, what are trendline yields? That's sort of a question every year. Some years it's a little bit more than others. And kind of as we talked about on this webinar, the crop in Brazil suggested that the next step up in seed technology, which somebody kind of told me about a couple of years ago, and we've been waiting for this to happen. But the US crop should be able to answer whether we've taken that next step up, because while conditions have been generally supportive, they haven't been ideal. And while conditions in Mato Grosso were probably a little bit better than they've been in the US, the yields in Mato Grosso were unbelievable. And so if we get trendline or better yields in the US, I think that next year's trendline yield, when we go to planting and before we have any impact from weather, probably will be a step higher than we're using this year. So this year we're using 52.5. If we get a really big crop this year, or trendline or better yields this year, I probably will bump next year's up more than just the straight trend line would suggest. Now, if we don't, then I think it still is kind of an open question. You could say that, well, the ground was dry, and as the other map shows, there's still a significant portion of soybean growing area that has been dry this year. And in particular, from, if you look at the percent of normal rainfall totals over the last 30 days, there's a big swath of area from central Iowa, maybe a little bit south of central Iowa, up to North Dakota, that has not gotten much rain. It's an inch or two below normal over the past 30 days. And that's an area where NOAA says drought conditions still exist. So crops in those areas, those are really big producing areas, will have struggled a little bit more than, say, crops in some of the eastern Corn Belt locations that aren't in drought. And it will take every seed in that area to make a trendline yield. So if that crop can get through and we can make a trendline yield, what it suggests is that the drought tolerance for soybeans has improved, which comes at the same time potentially as this shift in expectations for South American production from 150 million tons a year to, or sorry, from 200 million tons a year to 210, 215. It's almost tough to put a big enough number on the South American crop, just because we got almost nothing out of Argentina last year, 25 million tons, and we lost all of Rio Grande do Sul, which is about 20 million tons in Brazil. Of course, we produced, 25 million tons in Argentina, and I don't remember exactly what it was in RGDS, but it was less than half of what would have been implied by trendline yields. Those areas also suffered from drought. So I don't mean to suggest that the seed technology is so good that if it doesn't rain, you still get trendline yields, but it does seem like you probably don't suffer as much. And then the crops that do receive rainfall produce that much more, so that the average is still around trend line. And in Argentina, they got barely any rain at all. So the fact that they produced anything was really kind of not a surprise, but I think it shows that the technology continues to improve. And so the question then is just how much has it improved? And are we kind of on the next step up in the long-term trend in soybean yields? The other thing that this week's crop condition or crop progress report showed was a 2% decline in the portion of the US crop in crop reporting states that was rated good or excellent. That's not really a surprise. Last week was really hot across a lot of the country, and especially in those drier areas, I'm sure the crop does not look good. However, as we've talked about before, if you stress a soybean plant a bit, or if you stress any plant that produces fruit or seeds, what you will tell the plant, or what that tells the plant, is not to focus so much energy on producing leaves and big stems and tree trunks or whatever, but to focus on passing its genetic material along, which is always in the seeds or the fruit. So this little hot snap in late July, if it's followed by the rainfall that's been forecast, and if that rainfall trend continues through the end of August, I think the crop should be pretty good. If you look at the portion of the crop that's setting pods, it was 50%. That was ahead of last year and ahead of the 5-year average. And so the period where the crop is going to be filling pods is going to be shifted forward by a week or two. And usually it runs from the middle of August through the middle of September. So we're going to say the beginning of August to the end of August, or after the first week in August through the first week in September. This is really the time where rainfall is going to be the most critical determinant of soybean, and then by extension, soybean oil prices. And so the next month really will, between rainfall and temperatures, we should have a relatively good idea of where the crop is going to end up by the time that we get to the end of August. This month's WASDE report will be the first one to feature objective soybean yield estimates. And what we do to estimate the change is we generally look at crop condition ratings at the beginning of July, and then the beginning of August. And then we look at what that change implies for the change in yield over time. And given where we were at the beginning of July, which is 51, assuming that yields don't, or the condition ratings don't change that much next week, we're around 52. A slight increase might imply a slight increase in yields from trend line. I would say you might reduce that a little bit just because the conditions are so low relative to where they have been in the past 5 years. But again, I think that as USDA gets in there and actually starts measuring the crops and the number of pods per plant and all of that, we should again start to be able to zero in on whether the crop is going to be 52.5, 50, 55, somewhere in there. I don't know that I would bet a lot of money on 55, even if the seed technology has improved significantly, but a lot of that will depend on what rainfall looks like over the next month or so. The outlook suggests that most of the Corn Belt, and particularly I would say some of the drier areas of the Corn Belt, probably will be a little bit more favored for rainfall over the next month. The shift in the ridge from sort of the middle of the country, which is where it has been, west, is not unusual. The ridges usually, they move around a lot, and ridges retrograding from east to west is something that occurs relatively frequently during the summer. So that's not a big surprise, and it would leave Western US, it would set up almost the opposite situation that we had this spring, where Western US would be a little bit drier. The thunderstorms would ride up and over the ridge, and then rain on the eastern side of the ridge as they're moving south, and that would fill in a lot of the dry areas. So there's very little today that would suggest that soybean oil prices need to move significantly higher from the supply side, I guess I should say. As we talk about the demand side, you'll see that we've taken another little step up, or I guess we've crossed a psychological barrier in soybean oil use in biofuel production. Either way, I think that right now, I could make an argument that the crop will be trend line or above. That argument's simple. The crop's still alive and survived July fairly well. Now we're going to get rain that's going to fill pods, and the crop has been stressed a little bit, and so it's going to focus all its energy on filling those pods. The bullish argument, or that's the bearish argument. The bullish argument would be something along the lines of the weather pattern that existed in late July comes back and restricts rainfall in August, and then that reduces yields. Even in that case, though, by the time that we get through the US summer and we start to harvest the US crop, by the time we get into November and December, we'll be planting the South American crop. And like I said, expectations for that are going to be significantly higher than they were last year. And I would expect that what that will imply, short a real bounce in Chinese soybean demand is an increase in world ending stocks that will continue to weigh on prices. Earlier in the year, I kind of said I thought prices potentially could fall below 10. Given where they are right now, I don't know that we're going to see single-digit soybean futures in the near future, but I think prices will come under pressure and probably get a lot closer to 11 than they will to 14 by the time we get to through the U.S. harvest. Because once we kind of have a good idea of what the U.S. crop is going to look like, everybody's immediately going to turn their attention to South America. And until we get into the South American growing season, it's going to be difficult to argue that South American production isn't going to be significantly above where it was last year, even as we get into the growing season. Unless the drought continues in Argentina, I think that expectations are going to go up pretty sharply. So our forecast right now suggests that we are close to the upper end of the trading range going forward through the next year, and that prices probably work their way lower, even as oil share starts to move higher as the demand for soybean oil from biofuel producers continues to grow. All right, and then here's just a last bit to drive home really where the dry areas are, and it really is. I mean, it is in the heart of the soy belt producing, or the soybean producing region. Iowa and Minnesota, to a lesser degree, Wisconsin, South Dakota, North Dakota are some of the largest producing states. Now, South Dakota and North Dakota aren't bigger than Illinois, obviously, but even Illinois is in the darker brown and could use some rainfall. And again, over the last week or so, what we've seen is kind of thunderstorms that have moved across the Midwest and filled in a lot of areas. And that's kind of what we expect to see going forward. Not a generalized rain across the whole Corn Belt, but if you keep track of where the storms go, they're expected to fill in most of the Corn Belt over the next couple of weeks. There are very few areas that don't look like they're going to get rainfall over the next couple of weeks. And most of the rainfall is actually probably going to be focused on the drier areas because the ridge has sort of retrograded to the west a little bit. Okay, yesterday the EIA published its monthly biofuel data, including biofuel production excluding ethanol, and you can see that they reported a record. It was 400 and some, like 405 million gallons or something like that. The forecast was actually 25 million gallons below our prediction, which it was the first time this year that the realized total was below our forecast total. So we cut 25 million gallons out per month going forward. That seems like a simple solution, but it actually kind of fit well. And so now our forecast for production for 2023 for renewable fuel, excluding ethanol, whatever the EIA includes in that category, is 4.65 billion gallons. It was 3.31 billion last year. So that's a 1.3 billion gallon increase. Much of that has come from increasing renewable diesel production, although biodiesel production has been up a little bit. The pressure on margins recently probably slowed biodiesel production a bit in July. We'll find out in a couple of weeks when the EMTS data comes out. But it looks like we went through and did and revised our projections, and the recent run up in crude product prices, gasoline prices, diesel prices, has changed our outlook for profitability pretty dramatically from what we showed last week, which was essentially biodiesel negative and staying negative for the rest of the year in the foreseeable future. Now, when we get to the slide, you'll see not only has there been a pretty significant bounce in the margin, in our estimates of margins for biodiesel and renewable diesel in the last week, but our expectations have changed a bit too. And we now expect that biodiesel margins probably will go back to maybe not quite as high as they were, but again, into the upper end of the historical price range. One of the things that I think will be interesting is if that does happen, we're kind of predicting that biofuel, excluding ethanol, and again, this includes some stuff like naphtha, but generally that production will kind of stay around these levels until we get closer to the end of the year, and then it may ramp up a little bit. The 450 in November, we'll see. I think a lot of that will depend on margins and then also on where people are really with their RIN bank, their personal RIN bank versus their obligations. It looks to us like the industry will overproduce RINs a little bit, but not nearly as much as they have in past years. And it doesn't look like the RIN bank gets so big that it should disconnect RIN prices from feedstock costs. However, in the past week, we have not seen, or in the past couple of weeks, we haven't really seen that since the rally began in soybean futures and soybean oil futures. We haven't seen sort of a similar move in RIN values. Part of that may be because we didn't really see a lot of the low CI feedstocks follow soybean oil, and that's not unusual. Again, usually there's a delay there, 4 to 6 weeks. The relationship seems to have tightened up a little bit over this year, and it'll be interesting to see if that continues, given the fact that it used to be several years ago, 5 years ago, there wasn't enough low CI feedstock used that feedback loop between soybean oil and fats and greases was so tight. So if you were a oleochemical or somebody like that, you probably don't buy quite as frequently maybe, and it probably takes a little bit longer for an increase in soybean prices to kind of translate through to the fats and oil or fats and grease prices. The last move in soybean oil, it seemed like the fats and grease prices moved up a little bit more quickly. They didn't really follow it lower, and then they didn't follow it higher. So it seems like that the relationship's getting a little tighter, and in theory, it should be getting relatively tight, especially as feedstock demand grows and we get toward the limit of available supply. It seems like that relationship should be really close as renewable diesel and biodiesel producers start to choose their feedstock mix, or not start to, I'm sure they do now, their feedstock mix based in part on the profitability for each of the feedstocks. So it seems like that relationship probably should tighten up. We haven't seen it tighten up as of yet. And I think that the lack of movement in the low CI feedstocks probably has something to do with why we didn't see sort of a corresponding move in RIN prices relative to the move that we saw in soybean oil. I think if you probably just use like a weighted average for all of the feedstocks and looked at that price movement, it might be similar to the movement in RIN prices recently, although I don't think many or any of the fat and grease prices actually have gone down. So it may just be that soybean oil has come down in the last couple of days, and because RIN prices didn't follow it up and didn't follow it down, we're sort of back in balance. Either way, I think we'll understand more about that relationship and whether that relationship is going to hold as we get to the end of this year. Before the last couple of weeks, I would have bet a lot of money that the relationship would have held. The last couple of weeks have thrown that into question a little bit. And that part, the credit value part of the revenue side of the biomass-based diesel production business is going to be critical in production levels going forward, or I assume it's going to be. We've got production in June down a bit. We've got it bouncing back in July a little bit. And I think that if we see production drop in June and then drop again in July, then I think we probably will tighten up our production forecast on a monthly basis with our margin forecast. For the last year or two, it's been relatively easy because margins have been relatively high. And so we've based most of our production forecast on what is the expansion in renewable diesel and what do we expect production in biodiesel to be for the year, and then what does a seasonal look like for that to do month to month. And if we do get the reaction out of production over the next 2 months or the next 2 months worth of data that matches what we saw in margins, then I think we probably will start to tie our production forecast a little bit more closely with that. One of the key components to that outlook in that expectation is where we expect integrated biodiesel producers to be when margins drop. Do they produce or do they sell the oil to other renewable diesel producers? And if we don't do it, I think next week, I think we're probably going to do a little bit of outlook for the WASDE report and the MPOB report that's coming up. So if we don't do this next week, we probably will do it the following week. We'll probably go through the economics, or at least our assumption of the economics for integrated biodiesel production, and look at what the choice is for integrated biodiesel producers, crushers, to produce biodiesel or to sell the soybean oil into the market. And I think that even if our margin forecast proves to be a little bit optimistic, it still will be useful to go through that exercise and to start to understand a little bit where they might shut off or might not shut off. One of the data points in the EIA report yesterday was, of course, biodiesel capacity. And the EIA reported a really small 5 million gallon reduction from the prior month. And we still haven't seen a huge increase in the reduction in biomass-based diesel capacity. Last week and the week before, I believed that if margins were down at this level and stayed here, this was the first legitimate shot that we had at rationalizing some of that biodiesel capacity. Although, like I said last week, we have also gotten a fair number of requests about biodiesel economics and investing in biodiesel facilities. And so there is still interest there, and there's interest from financiers. So I would assume that if we get the bounce back that we expect in margins, biodiesel capacity is probably going to hang in there. And if that happens, then our outlook for 2024 is going to change pretty dramatically, because right now we have a relatively large reduction in biodiesel production built into 2024. We probably will limit that a little bit and then revisit that in early 2025. It's hard to imagine that in early 2025 that the economics won't favor rationalization, but we've got to get through 2024 first. And we had assumed that the significant buildup in renewable diesel capacity would pressure biodiesel margins. Ultimately, that would lead to rationalization in biodiesel capacity. And we just haven't seen that yet, except for the last couple of weeks. But even that didn't last long enough to have any real impact on production capacity going forward. It may have an impact on production. And I think that the EMTS data for June and July will be really interesting from that perspective of relating the changes in production to the changes in margin. So feedstock use, like I said, we kind of went above a psychologically important level in soybean oil usage. So we went above 1 billion pounds a year to 1.14 billion pounds in May. And that's obviously a record. And it makes biofuel usage of soybean oil essentially equivalent to non-biofuel usage. So it's about a 50-50 split now, although the non-biofuel usage has remained a little bit stronger. And I think over the last couple of months, it probably has averaged just about 1.2 billion pounds a month. So not quite 50-50, but pretty close to 50-50. If you look at the other two categories where we've added the data labels, you can see increases in used cooking oil / yellow grease and in canola oil usage in biomass-based diesel production, which took feedstock use up to a record of 2.73 billion pounds. For the balance of the year, we essentially have a 2.77 billion pound average. A lot of that has to do with the next couple of months being relatively smaller on feedstock usage, and then the last couple of months being above where we are right now. It also suggests that, or our forecast is based on the idea that soybean oil will continue to grow and be a significant portion of the total feedstock mix. And of course, that's true. Soybean oil is always going to be a significant portion, or at least until either the US does something like Europe, where they limit the amount of fuel that can be produced from vegetable oil, or the IRA kicks in, and then that reduces the profitability of vegetable oil a little bit relative to some of the other feedstocks. However, even in that case, it still is going to be the situation where we're going to need more soybean oil just to meet the total feedstock demand than anything else, just because that is the most available feedstock. And we can't increase the production of anything else in response to prices, except maybe for UCO. If we look at what soybean oil has done relative to previous years, and when I put this up, it must have been like in February. The question was, when will that start to accelerate? And it looks like the answer was in May. And so if you look at the year-over-year change, it was up about 30% from the same month last year. And that was about a little bit more than 8 million pounds per day, 8.5 million pounds per day additional usage from the prior year, which is quite a change from December, where we were down about 5%. Going forward, like I said, the next couple of months look a little bit lighter, and then we start to build into the end of the year. This stops at the marketing year, but it looks like that has finally started to happen. The question then is, so how much of the total feedstock will be represented by soybean oil? How much by the other commodities? And you can see that in the last couple of months, that soybean oil's portion of the total has been around 41%, somewhere in there. And we have it closer to 45% or so going forward. And I think that we're going to keep sort of forecasting the way that we forecast. That's probably going to end up suggesting that we use a little bit more soybean oil than we typically use, or than is typically reported. However, at some point we will kind of reach the available supply of fats and greases, and then any additional gallon that needs to be produced or is produced beyond that then needs to come from vegetable oils, either soybean oil or canola oil. And so I do firmly believe that if everything else sort of stays the same, that we're going to hit that point, and then soybean oil as a percent of the total feedstocks will start to accelerate with the growth in production and in production capacity. Whether that happens in June of this year, or it happens in December of this year, or it happens in May of next year, it's a little difficult to judge, in part because while we have what we think are good idea of the feedstock mix for each individual renewable diesel producer, we don't know exactly what they use each month, obviously. And so we kind of estimate, and the amalgamation of those estimates gives us where we are. And just from a guy that's sitting staring at spreadsheets, from that perspective, not involved in the industry other than analyzing it, not making those decisions, from the spreadsheet perspective, it seems like we probably are closer to hitting that point than we are away from it. And so again, while I don't necessarily expect that we will hit that point in the next month or two, our forecast will kind of reflect that. And all of that said, the soybean oil usage in May was actually above our expectation, not by much, by like 30 million pounds. But even with our expectations, which again tend to favor soybean oil a little bit more and tend to forecast stronger feedstock demand than is usually reported by the EIA, we still weren't quite there. And that was similar across a lot of the feedstocks this month. Historically, it's kind of been the opposite. And given the production that we saw in May, I think that maybe it's not surprising that feedstock use was a little bit above our expectations. The next 2 months, it probably will be on the other side. It probably will be a little bit below our expectations, just given our prediction that that production slows with margins over the last couple of months. So in the end, I think that the portion of the total feedstock mix represented by soybean oil is only important if, one, we run out of fats and greases and we need to use a lot more, significantly more soybean oil than we have historically, or two, if we do I lost that thought. I apologize. I really can't remember the second one right now. Oh, I hate when that happens. I can't remember it. If I remember it, I'll come back to it. I'm sorry about that. I'll say that the other thing that I would say is 56.2% or 56%, 55%, whatever, of the feedstock mix going forward, we expect to be vegetable oil, that soybean oil or canola. And the other thing that the EIA data showed was that canola oil use remained relatively strong in May, 290 some million pounds. That's just shy of the record, and means that we probably will need to bump up our canola oil feedstock demand a little bit going forward. We were already above where USDA was, and if you looked at the average for from January through April, our forecast pretty much lined up with that for the rest of the year. And I think based on this month's data, we'll probably will raise that up just a tick, and would be really surprised if USDA didn't raise their estimate of, or their prediction of 22-23 canola oil usage in biomass-based diesel production. All right, my least favorite charts, but this is the average yield for biomass-based diesel. This is based on the EPA production data and the EIA feedstock data. I didn't show the EIA one this month because we're revising our EIA data series. And so from going forward, we probably will use that. One of the things that I kind of need and want to figure out is, in that renewable fuel excluding ethanol category, what can I actually take out of that so that we get a little bit closer match up of the feedstock demand and the fuel production, both because it'll both come from the same source. And then we'll just be talking about biomass-based diesel, hopefully, and not biomass-based diesel and naphtha and some other stuff. So take this with a big grain of salt. 7 pounds, just over 7 pounds a gallon is below the average for any of the feedstocks individually. 7.5 pounds for soybean oil is about the is the low end of the range there. So an average that's below that doesn't necessarily make sense, except for the fact that we're including things like naphtha that are actually a byproduct of renewable diesel production and don't require any feedstocks to produce or any additional feedstocks to produce. So, or at least as far as I know, I honestly don't know a lot about naphtha production, but that's kind of what I assume. Either way, I think that the important thing here is probably the trend, and the by commodity data suggests that the increase in soybean oil helped to drive the yields a little bit lower. Now, everything increased a bit, but soybean oil actually increased by almost 200 million pounds, which is a pretty significant increase, especially relative to some of the other feedstocks. It's a 20% increase, and some of the other feedstocks didn't increase by that much. And so you have the yields come down a little bit. If you look at the EIA on EIA data, it's kind of a flat line, not a lot of change month to month, which is the other reason that I decided to show this one, but it's probably the last time you'll see this chart. All right, so on the biomass-based diesel capacity, like I said, we got a 5 million gallon decrease in biodiesel in May, according to the EIA, and we didn't get any change in renewable diesel. So that was a little bit below our expectation, but you can see we still have relatively aggressive build out over the balance of the year. It still is, we still suggest that there's going to be 950 million gallons of additional renewable diesel capacity coming online before the end of the year. I think that might be a little optimistic at this point. We reviewed the starting dates recently for all of the plants that we have, and we didn't see anything that made us think there were significant changes, but I think I may need to go back and re-look at that and maybe change some of my assumptions, because it seems 950 million gallons seems like a lot through the end of the year. Now, that said, our expectation hasn't moved a lot since July. This is a chart I've shown several times and kind of made the point that as expectations for renewable diesel production went, so did soybean oil prices. And the move since January back up to where we are now is due in part to the support that we've seen in soybean oil prices, is due in part to that change in expectations. Obviously, what's going on in soybeans and with the weather in the Midwest also has an impact. But I think this also has an impact as well, obviously, since it's basically 50% of the demand almost at this point, or I guess renewable diesel isn't. But I think that it will be interesting to see how that goes, and again, whether the pressure that we've seen on margins for both biodiesel and renewable diesel in the past month or two has slowed any of the projects down. It can be difficult to try and figure out when these plants are going to open, but once we go through this stuff again, if we make any significant changes, I'll bring this back up and show everybody. So what does that mean for capacity utilization? So again, this is another statistic or another data series that is a little bit, there's a little timing mismatch because it's EIA capacity versus EPA production, but at least it's consistent. And so even if the overall level isn't correct, which at 48% almost has to be not correct, even if that isn't correct, the trend should be relatively close. And the trend has been relatively steady. Now, we still have the trend going up and production rising a little bit faster than our expectation for capacity. So I think that will happen, but a lot of that will depend on where our renewable capacity number is and renewable diesel capacity number is, and then what the margins do. We've got the average through the end of the year, just a little bit higher than where we have been. Some portion of that comes from the last couple of months, of course. And of course, in June and July, we've got it up a little bit, it looks like, from where we are now. Wouldn't necessarily surprise me if July ended up being a little bit lower. When somebody raise their hand, I'll answer your question. If you can type it in the chat or in the questions, that'll be easier. I'm not an expert at calling on people and allowing you to talk. I think I know how to do that. And so if you have problems with the chat or the questions, raise your hand again when we go to questions, and then I'll try, and we'll both learn together whether I can actually do that or not. Okay, so margins, our margin outlook. And you can see the big drop down and then the relatively quick ramp back up. And while last week's assessment of biodiesel margins didn't erase all of the losses, it did erase about a third of the decline. So last week was negative 65 cents per gallon was our estimate. And this week it's negative 42 cents. So maybe not quite a third, but pretty close. And given the move that we saw in fuel prices and fuel values, we revised our fuel price forecast, and that made a huge difference. And then of course we also lowered our feedstock price forecast, or we lowered most of our feedstock price forecast, with the biggest decreases really in soybean oil. Fat and grease price forecast came down a little bit in some cases. In some cases, in actually probably a fair number of cases, they actually went up a little bit. But despite that, we still expect that soybean or that biodiesel profitability is going to return, again, maybe not to the historically high levels that we saw earlier this year, but much closer to the average or the upper end of the longer term average range, which is about 35 cents a gallon. And that is actually not a bad margin for producing biodiesel, even if it doesn't look as nice as it has been through much of 2022 and late 2022 and early 2023. And it really was, again, because of our feedstock assumptions, which 75% soybean oil and 25% yellow grease. This is also more heavily weighted towards the margin is more heavily impacted by changes in our soybean oil forecast. So an increase in fuel prices and a decrease in our soybean oil forecast really changes the outlook for margins. I don't really enjoy, and one of my least favorite things to do in my job really is to do what I've done in margins over the last couple of weeks, which is to whip around from historically high to historically low back to historically high. I really don't like to do that, but unfortunately what we've seen last week and in the last couple of weeks, I think, is a combination of maybe a little bit of kind of maintenance issues at some of the refiners, that kind of thing, but also probably a shift in expectations for the US economy, where I think a couple of months ago, most people were hoping that the Fed might be able to engineer some kind of soft landing. And now I think that the consensus is coming closer to maybe not sort of a landing at all. Now, I think, and I think even in their statement from the last meeting and interest rate decision, I think the Fed said that they weren't forecasting a recession in the US anymore. Somebody said that anyway. So I think that has helped contribute to the rise in fuel prices, and more importantly, probably makes the short-term increase in fuel prices look a bit more sustainable than it would have a couple of weeks or a month ago. The key question is whether that will actually happen or not. So I can sort of make the argument from both sides. So I could make the argument that the economy is recovering and we probably have been through the worst. And then there's enough statistics that I can show you that would argue the opposite. So it's difficult to predict any of this stuff, of course. And it wouldn't necessarily surprise me if a month from now or 2 months from now, we come back and we say, actually, soft landing wasn't even in the cards. We're in a bit of a recession, or we've been in a bit of a recession. The amount of data that shows that the economy is starting to grow again relative to the amount that shows that I would use to make the opposite argument is pretty close. They're relatively close to the same. And so I think that that while our job isn't really to predict the economic outcomes, our job is to focus on the commodity markets. The economic outcomes in this case are probably pretty important. And I think that while we certainly have recessions and things certainly can turn out to be worse than expected or better than expected, in general, most of the time, if you kind of assume that things are going to behave as they have in the past, then that generally gets you more accuracy than if you predict big swings in things. So if you predict the economy is going to crash or that it's going to explode higher, obviously predicting 2% growth or something like that is going to be right more often. It doesn't necessarily mean that you won't ever predict big gains or a big slowdown in the economy. But what it does mean is that when I talk about all of the data that suggests that the economy could not have any landing at all, or all of the data that suggests that we could go into a recession, it's so close that betting on normal is kind of the safest. If one or the other really had a lot more weight to it, then I probably would shade our fuel price forecast whichever way the data leaned. But right now it seems to me really close. And I'm sure there will be people that will agree or disagree with where the economy is headed. And what I would say is that those are our expectations. And so that should help provide you with how you might adjust the outlook for margins based on your deviation from what we think. So if you think the economy is going to get significantly worse before it gets better, then the outlook for biomass-based diesel margins is probably much closer to what we saw last week or the week before than what we're seeing today. And if you think that the economy is doing really well, then I would suggest that margins could be a little bit better. However, the other thing that I would say is that because it's fuel prices tend to be world prices, certainly crude oil prices are world prices. When you get into products, it gets a little bit more domestic, but it still is influenced by the world markets. And so even if the US doesn't go into recession, China's economy being a little bit weaker than expected, the European economy, I think, is coming back a little bit more slowly than the US economy. And those things could also weigh on fuel prices. And really, I think that given where our soybean oil forecast is right now, that the margin calculation is going to be much more a function of movement in fuel prices, at least in the short term, over the next couple of months, than it is going to be in feedstock cost, unless the weather pattern changes and soybean oil prices explode higher with soybean prices. For renewable diesel, kind of a similar pattern, although not quite as much of a dip in profitability. And in general, the trend kind of seems to be the same. I think one of the things that I've gotten wrong about my whole assumption that growth in renewable diesel capacity would pressure biodiesel margins has been that growth in renewable diesel capacity hasn't really pressured biodiesel margins that much last couple of weeks or last 2 months notwithstanding. And if you look at this, the trend in renewable diesel margins has kind of gone down with the increase in renewable diesel production capacity. And one of the things that I think sort of highlights that is the spread between biodiesel and renewable diesel in the California market, or renewable diesel less biodiesel. That has traded at a premium for renewable diesel for most of the last 2 or 3 years. And then in late 2023, early this year, biodiesel actually went to a premium to renewable diesel. That is one that's tough to figure out. But what I think it does suggest, just from a Econ 101 standpoint, is that there was too much biodiesel and not enough renewable diesel. And that would suggest, that would sort of support this idea that renewable diesel margins are more influenced by renewable diesel capacity than biodiesel margins. When you say it out loud, it sounds like it makes 100% sense. However, given the difference in the margins for renewable diesel and biodiesel, and the fact that renewable diesel is a drop-in fuel, and I don't mean this to be in any way critical of biodiesel, but the fact that renewable diesel is a drop-in fuel, I kind of assumed that renewable diesel would essentially take market share from biodiesel. And I don't think that, well, that hasn't happened yet. And if the margin forecast is actually true, or it verifies, I don't know that it's going to happen. So it will be a case where we build a bunch of renewable diesel capacity. We don't necessarily shut down a lot of biodiesel capacity, and then the market just needs to figure out how to absorb that, or where margins do come under pressure. I still think that ultimately it's biodiesel, but it hasn't happened yet, and it would not be the first thing that I've gotten massively wrong in my career. Either way, the outlook for renewable diesel, just as a reminder, our feedstock mix. And when we get on the when we switch from our website to the platform, I promise I will post the feedstock mix on the charts. The feedstock mix is 50% bleachable fancy tallow, and then 25% yellow green or UCO, and 25% DCO, used cooking oil and distiller's corn oil. All right, and then I just want to go through sort of a by commodity profitability charts. And again, if you look at the movement in the last week, you saw basically profitability for all of the feedstocks up and up sharply, especially if you look at it compared to the relatively small declines over the last couple of months. Each week, you don't typically see moves that are that large, and especially not across every commodity. While they do tend to move together, you don't always see all of the moves across every commodity. So that gives us a little bit more, that in the weather outlook, honestly, give us a little bit more confidence in the lower feedstock cost outlook for at least the short term, and then probably in the longer term too, as South American production kicks in and soybean oil supplies in the US and in the world get a little bit more balanced. I think this is a turning point, but again, it could be that we see all of this come lean down because the economy is much weaker than we expect and fuel prices start to fall. I think crude oil in July had its best month since February 2022 or something like that. So there has been a bit of an anomaly in the energy markets in terms of performance over the past month. It hasn't really translated into the product prices, but last week it certainly did translate into the product prices, and our forecast for fuel prices were off by, in some cases, 30 cents for biodiesel. We had to raise our forecast. So that's a significant adjustment. And that's why the profitability outlook is so different this week than last week. Biodiesel, you get, or I'm sorry, the last one was biodiesel. This is renewable diesel. You get some of the same, although the increases are smaller, and not every commodity showed an increase. And so it looks like poultry fat, which one of the surprising things about this past year has been sort of the decline in poultry fat usage, but poultry fat and distillers corn oil look like the two that moved lower relative to the others. I'm not 100% sure why, and I will go back and look into those a little bit more to make sure there's not an error or something. I think it's a bit unusual that we have such a big increase in biodiesel, and we don't necessarily see all of the commodities going up for renewable diesel. I don't think that that's impossible, but it's a little odd and warrants a little bit of looking into. For both commodities, the most profitable feedstock was yellow grease, not UCO, but yellow grease. UCO was a close second in both cases. It's not always the case where yellow grease is more profitable than used cooking oil. And I think that yellow grease is certainly probably a little bit more difficult to deal with in terms of pre-treatment and that kind of thing than UCO. So our assumption there, our calculation there is really just a price and revenue kind of, or a cost and revenue kind of calculation. It doesn't take into account whether one commodity requires more pre-treatment or refining than the others. All right, so last one of these that we'll look at, which is just biodiesel made out of soybean oil across all of the regions of the country where we track biodiesel prices. And again, you see a similar chart to the one that showed all of the different feedstocks for biodiesel with sharp gains across all of the regions. This past week took soybean oil back into the profitable per pound average, 2.5 cents basically, and 25 cents for 25 cents per gallon for the Western Corn Belt, which was the region that had the highest profitability. Although on this chart, it looks like it's the West Coast. So something else I will look into. Okay, this is the last chart, and I wanted to follow up a little bit on our discussion last week about the difference between soybean oil prices in Argentina and the US and the potential for big imports into the US because of the substantial difference in prices. This is a little bit different look. So this shows the refining margin versus Gulf basis, which is, while integrated biodiesel producers are choosing between producing or selling the soybean oil, the same people are also looking at, do we produce or do we export the soybean oil? And it hasn't been much of a choice this year, which is why expectations for 22-23 exports are around between 3 and 500 million pounds, down sharply from the last couple of years, which is down relatively sharply from the long-term average. The rise in US basis at the Gulf is more reflective of the domestic market. So on some level, the Gulf is the interface between the US domestic market and the world market, obviously. And there are times when the world market will control that price, that basis price, and there are times when the domestic market will control that basis price. Recently, it's mostly been driven by the domestic market controlling that price. But given what we talked about last week with the big separation between Argentina and UF Gulf prices, you would think that US Gulf basis would be flat, but it's not. It's been rising. I think that reflects more, like I said, I think that reflects more that US domestic demand is really robust, and the growth in biofuel feedstock usage now is such that domestic usage is relatively evenly split between non-biofuel and biofuel usage, even though non-biofuel usage hasn't really slowed that much. So I think that this is something that is domestically driven. And as such, I think that this is probably one of the critical comparisons. So if the export basis continues to rise, then actually for the crushers, there will be a choice between, do we sell it domestically? Do we sell it into the export market? Do we turn it into biodiesel? Would be the three choices. And if they can make more money exporting it, then I think that that we will be in a situation where it will be difficult to back that up with an increase in exports, I guess, is kind of the bottom line, because it's the domestic market that's driving it and not the world market. If I'm an importer of soybean oil and US basis is, I would need to be sort of 12 over, 13 over for exporting crude to kind of make sense and offset the refining margin. Because that's what's driving it, doesn't necessarily mean that if they're willing to sell it at 12 cents, that the world market is willing to buy at 12 cents, especially if Argentina is 30 cents cheaper. So I bring this up to sort of point out two things. One, to kind of give a little bit more detail on why there's a separation, the big separation that we see between Argentina and the US, but then also to kind of talk about this idea that crushers really have a couple of different choices of what to do with soybean oil once it comes out of the bean. And when these two lines cross, then they'll have a new choice, and that is, do we refine it or do we export it? Do we refine it or do we turn it into biodiesel? And that will start to get pretty complicated. But just remember that even in that case, while it would look like the US should export more soybean oil, I don't know that until I really saw a change in the trend in export sales or export shipments in either the weekly data or the monthly data, I don't know that I would really make any changes to our outlook, even if the Gulf basis jumped to 20 cents tomorrow. I don't think that I would increase my export forecast by a penny, because without the demand side of that, then there isn't really anything to change. So until we see the Gulf basis above, or at least much closer to the refining margin, and we see the difference between the Gulf basis and Argentina basis narrow pretty dramatically, I'm going to continue to predict 250, 300, 400 million pounds of US soybean oil exports. And there's not really anything that seemed really apparent in the short term that is probably going to change that outlook. But I just thought that this was kind of an interesting chart, especially given what we talked about last week. It doesn't really fit with the rest of what we're talking about today, but it would have been a good chart to show last week. All right, that is the end of that. And so if you have questions, if the person that raised their hands has a question, if you can't get the Q&A or the chat to work, and you can send the chat to me directly, I think, by typing my name, and then I'm happy to read that out and respond. Or if not, you can always send me an email and I will respond. It sometimes takes me a little while, I admit, but I will always try to respond. And if we need to get together and talk about something, I'm happy to do that as well. All right. Okay. I think that is going to be it then. again, if you have questions or need anything else, please reach out. Otherwise, everybody have a great week, and I will see you all next week. Thanks so much for attending. Bye-bye.